Good morning, traders. Taking a look at the charts. Equities are down this morning, which isn't a big surprise. We talked about this in our afternoon update, how yesterday we saw panic selling on the stock market. It closed. It ended up closing up at 10, which is a high level. Anything above 8 is generally a fairly significant wave of panic. Anything over 3 is short-term panic. And a close of 8 or higher can sometimes stand out to be a very significant pivot low on the charts. Now, when we have this type of fear, as I mentioned last night, if you get our afternoon updates, then we expect the market to have further washout this morning. That panic should typically carry over. Everybody will probably see fear spike up even higher. There'll be lots of emotions, lots of fear. Markets will sell off, and then we can see a very sharp recovery. Usually after a close above 8, it takes 1 to 3 days for the market to wash out, stabilize, and then become a very significant pivot low on the charts. If we just zoom back a little bit, you can see here we had another big wave of massive panic selling. It created a very sharp standout low in the market. We had another wave over here, which created another standout low. And we are creating another one now. So at this point, the market is set to gap lower. Obviously, there is some more news with Trump's tax cut bill, more or less narrowly getting passed this morning. And the market, you can see this morning, starting to sell down a little bit and run down. I guess, again, it's nothing significant. We're already expecting selling this morning just based off the charts. The charts are already telling us there's fear. We're probably going to see lower pricing today and a lot of people panicking. And then the market is actually setting up for another rally. That is kind of what happens in a rising trend when we have these waves of fear, and especially when the moves are driven by news. They're usually short-lived. So if whatever happens with the bill here, if the markets do take off and rally, everybody will blame it on the bill. But overall, the markets are already telling this, and that's why we do the technicals. We have a lot of trades, a lot of setups. We see patterns unfolding and have expectations of where the market's going. And then news typically happens around those points and continues to move them. The market is very smart and tends to move before and provide these setups before the news actually hits. And so that's kind of where we are right now. And a quick reminder, if you like short-term analysis, understanding panic selling in an uptrend as opportunities, FOMO buying in a falling market where it tells us where market highs are, and identifying trends to know when something is trending up or down, all of that you can actually get in my book, which is Technical Trading Mastery. You can pick it up pretty much anywhere. And chapter 10, I teach about the trend analysis. Chapter 11, I talk about the overbought, oversold, the volatility. And then chapter 12, I talk about the FOMO, the panic and FOMO buying indicator, how you can use those calculations, throw them on your charts, and take advantage of that. Of course, if you want to learn longer term investing strategies, which is what I focus on with our signals that we're talking about here, that's Asset Revesting, which is another book. And again, you can go to our website and join our free newsletter if you want to stay up to speed on more analysis and stuff on the markets. So yesterday was a big move in the markets. I covered the yields and bonds fairly in a little more detail. Overall, bonds are down again this morning. If we take a look at bond futures, you can see they're down about another 0.6%, really picking up speed in the last 2 hours here to the downside. You can see on the daily chart, it is in free fall mode. If we go to TLT and we just pull up the 1440 chart here, which is similar to a daily chart, you can see where we are in pre-market. We're getting down. We talked about how 82 and 81 are those downside targets. And we talked about that way over here. Just as this market put in reversal, we talked about this chart pattern is pointing to 81 to the downside, and you shouldn't be surprised if it hits there. And it is going to create a lot of panic. And of course, if the bond market is falling, we tend to see yields go up. And I touched on this yesterday. It's amazing when I talk about yields, how many people get angry with the analysis of yields, which just goes to show how sensitive everyone is. More or less, it looks and feels like yields are putting in a rounding bottom. It has a pop, pause, pop, pause. It started to move up yesterday. It has the potential to continue to push higher and potentially a whole lot higher. This is the 5-year. And of course, if we see yields go higher, including the 10-year, you can see the 10-year's done the same, very similar. It's picking up speed. It has potential to go a whole lot higher. If yields keep going up, bonds are going to keep falling. And the longer term chart of these, which is where I get the most pushback every time I bring it up, and I'm just showing what the charts are pointing to, so don't shoot the messenger, but it is pointing to 8% yields. Not saying it's going there, but that's what the charts are pointing to. And if they did go there, or even if yields keep grinding higher up into the 5s and 6s range, that means inflation is here, probably stagflation. Economy is going to weaken. High yields are going to hurt a lot of companies, and I'm going to touch on the dividends, and long-term investors are going to get hammered. But overall, if the rates do continue to take off and push higher here, TLT is going to get crushed. It's going to drop like 40-50% from where it is. And this is what people don't understand. People keep thinking bonds are a safe play. Oh, they'll come back in a year or so. They're in a strong downtrend. We have obviously unique times, and who knows what's going to happen with the bond market and rates and the economy. And that's why expecting bonds to put in a bottom and rally. I know people don't want to hear this. That's picking a bottom. You're in position and you're hoping and praying it's going to go up, and that doesn't always work. And it can go against you, and the bond market could suffer if rates get out of control and keep moving up, and the bond market keeps collapsing. So what do high yields do? Well, they're going to hammer a lot of stocks. Companies with lots of debt. If we take a look here, utilities have a ton of debt. I'm just going to, I might as well stay here. So on the daily chart, utilities took a big haircut yesterday. They're already trading sharply lower again today, this current bar. Of course, utilities have tons of debt. They're up to their eyeballs. They do pay dividends. They're a dividend-paying stock, but they also carry a ton of debt. And if rates are staying up or going up, it's going to reduce the amount of profits they have. If we take a look at energy stocks took a haircut yesterday as well, and they're moving already down again today. They took a big haircut. Again, they're big dividend-paying stocks, but they carry a ton of debt on their books as well that they'll have to service. And if rates stay up or go higher, they're going to have less profits, which means lower dividends. And so investors sell knowing that. And of course, if we take a look at the dividend space, just look at dividend stocks yesterday. Dividend investors took the biggest hit. It was down like, I don't know what it was. It was huge. It was from the previous day's close, dividends fell 2.8% yesterday for supposedly holding the strongest, safest, most profitable companies. You took the biggest hit out of the market. Now, obviously, it is very clearly trending lower. And I also mentioned in the afternoon update yesterday how the emails rolling in, the lots of rude emails, people totally hating the idea of falling bonds and rising rates, and that I said it, we're going into a bear market, yet the markets are going higher. There's so many mixed misconceptions or just confusion of what I cover, and I try to explain it. I've been talking about the market putting in a major top for a long time. And I have also been talking and calling for a big dead cat bounce. We exited the market; it's collapsed. I've been talking about a dead cat bounce that we're still in, and we need to let it roll over before we go into what I believe is going to be like the full-on bear market. Yet people seem to hear only we're going into a bear market. I know a lot of people who keep shorting the market and buying inverse ETFs, and it just keeps going higher, and they get angry at me because I said we're in a bear market and the market's going higher. And some people saying like, now you're long, you make no sense. So the biggest thing, and this is what I always try to clarify, is long term, I believe we're going lower. Short term is what we're actively trading and managing our positions wise. We exit when volatility and signs of weakness are coming. We get in, we ride the market higher when the trends are up. And eventually when it rolls over, we'll be looking to profit from falling pricing if we get the right criteria with an inverse ETF. But you need to let this bounce finish. And just because it is a strong bounce percentage-wise doesn't mean it's the start of a new bull market, doesn't mean that it's not a dead cat bounce. In 2008 we had this. In 2000 and in the 2000 market top, we saw the NASDAQ fell. Actually, we could just go back and take a look at it really quick here. The NASDAQ fell 2008, it fell 25% and then rallied 23%. If we go back to the 2000, just take a look at, let's just go to the low here. The NASDAQ fell and had that initial crack to the downside, the market fell 47%, and then it had a dead cat bounce or a bear market rally, whatever you want to call it, of 64%. So these things can be huge. Just because it's a big rally doesn't mean a new bull market's starting. This is just the crack to the downside and the complacency move, and then eventually it just goes into like this never-ending selling spree. So people just need to understand the time frames I'm talking about. Yes, I've been bearish for a long time. Doesn't mean we're not long. I was bearish in 2023 and we played the upside of the market. We don't trade what we think or feel. We trade what the charts are giving us, and we manage our positions because investing and trading is all about risk management. There are a few characteristics that really make successful traders and investors stand out as a winning trader long term. And in order to be a successful trader, there's a whole bunch of stuff you do need to focus on and understand and execute and follow, which is like I objectively define my trading edge. I know my trading setups. I know the charts. I know my edge of what I can grab, what types of moves in the markets I can identify to get in, lock in gains, and move on. So I define my edge. I always define my risk. I know every trade that I get in. I know how much, where my stop is, and I'm happy if it gets stopped out, that is fine. And you need to know your risk, and you have to completely accept that. So if that stop gets hit, you don't just say, well, forget it. I'm just going to hold on to it now and let it come back. No, you just have to exit that trade, take the loss, man up, and be a loser is the reality of it. And we're just wrong sometimes. And we have to take that loss and move on. And on top of that, we have to act on our trading edge without hesitation, no reservations. We just have the trade set up knowing in the long run, this trade pattern works out as long as we execute the trade and follow the risk management. And we need to make sure we lock in gains, which we've been doing. We've locked in gains on our SP 500 trade, on our QQQ trade, on our Bitcoin trade, our uranium trade. We have our stops moved up. So no matter what, if they start to fall, we'll end up exiting and closing those trades with profits. And you have to pull money out of the market when it gives it to you. You don't just ride it out until it turns into, hopefully, a massive life-changing trade, which most of them don't. If you hold on to things, eventually they will usually take your money if you're a short-term trader because of volatility. So pay yourself, and you need to monitor your susceptibility to the markets for errors. And I journal pretty much every day, which are my videos, which are my updates to subscribers and to all of you guys in the comments. More or less, I'm covering the markets every day, explaining why I'm thinking, what we're doing, recovering our strategy, and documenting how we think and feel and what's going to happen. And I do that for everyone else, but it's really the ultimate journaling for me. And if you start to do something like that yourself, you will, become a much more sophisticated trader, and you won't be trading off emotions and news and things like that. And if you do all those things, you're going to find that the markets aren't that complicated. They're not that emotional. I know the amount of testimonials and comments we get all the time here in the members area is how amazing it is to follow the markets with our analysis and have a strategy in place so we can execute these and take away that panic, that fear, that uncertainty. Once you strip all that away, strip away the news, the uncertainty, and say, hey, we've got a game plan. It doesn't matter what happens. We're good. We're not going to fall apart, and it doesn't matter what Trump does. It doesn't matter what the markets do. We've got a game plan, and we are going to navigate it safely, and that is huge. Anyway, let's take a look at the rest of the markets real quick. Let's see where money is flowing today. So it's flowing out of stocks, out of bonds. We are seeing money flowing out of gold and silver as well. Money is moving into the dollar just a little bit. It's trying to find a little bit of a bid. We are seeing money flowing out. Actually, we're seeing money flow into Bitcoin. Bitcoin's up 2.6%, pushing up here again. We are very close today. Looks like actually we're going to hit our next target for our Bitcoin trade at the open today, probably, or just after, which will be awesome. And crude oil here down 1.5%. So obviously uncertainty, and we're just seeing some profit taking in the energy space. It is in a downtrend, lower highs, lower lows. Again, we're not that bullish on that space. We're pretty bearish, and we're waiting for the energy stocks and for the stock market itself to roll over, because I do believe eventually we're going to see the market roll over, and we'll want to play an inverse ETF as a discretionary trade. I think there's a lot, 30-40% downside with this trade with a 2x ETF, inverse ETF, when the time comes. I just want to go back to gold real quick, just because everyone here is pretty much a gold bug. If we look at the chart pattern, obviously it looks like we're kind of channeling down in a very controlled way. So we're back up at a short-term resistance area, a falling trend line. We're kind of tucked up through lots of volatility and volume through here, kind of through a big pop. So we've got a little cluster above, got a little cluster below. So we're stuck right in that resistance area. We'll see how the market goes from here. Again, in the grand scheme of things for gold, gold is still in a strong uptrend. It is taking a pause. The next potential push, if the precious metal space gets another push here, is 37.50 to the upside as it continues to become that defensive play and people moving away from different currencies and assets and stuff, and want to get into a solid asset that is kind of outside of the financial system. But overall, we'll see how this plays out. Again, the monthly chart looks pretty bearish, looks like a topping type of pattern, but the month isn't over. We need to see a monthly close for those patterns. And of course, if I take a look at the monthly chart, you'll see what I'm talking about, which are these wicks here. If we have these upper wicks and it stalls out, we could very easily, obviously when this candle was down at the bottom here, it was a very, very much so a reversal looking pattern. But again, you always have to wait for a bar to close. Monthly bars are very powerful, but you do need to wait for them to close. Same with the weekly chart, because for all we know, a week ago when it was down here, it looked like the market, gold had put in a significant top. By the end of the month, for all we know, we could be right back up here and will actually look like it has that momentum to carry to 37.50. So we always have to wait. Monthly charts, wait for it. Weekly charts are very powerful. Probably start doing more so of a weekly wrap up on the Friday videos using the weekly charts, because weekly charts are powerful and they show where momentum can carry into the next day. When you look at the weekly chart of gold, it looks very strong. It's still bullish. It obviously has some upper wicks, but it has a bull flag pattern and it is closing here. And obviously it is pointing to that 37.50 as well if the market breaks it to pop. On another note, as many of you know, my son crashed and broke both of his wrists several weeks ago. Anyways, today he got his cast cut off. Check this out.
Okay, and then cut this side here. You remember where extra is?
Yeah.
Slide out.
It's alive.
Oh my gosh.
It's alive.
So head over to extra.
Oh my.
Anyway, that's it for now. Talk to you soon. Bye-bye.